Roth conversions can be pretty simple. You push the button at the end of the year, withhold taxes right from your conversion, and voila, you're done. But here's the thing. If you stop there, you might be missing out on some serious extra value. In today's video, I'm going to show you 3 smart ways to squeeze more juice out of your Roth conversions in 2025. Let's dive in. To begin conversations around Roth conversions, many of you have seen me go back to the Roth equivalency example. It's a simple proof. If your growth rate is the same and your tax rate on conversion is the same as your tax rate on withdrawal, you end up with the exact same after-tax wealth. Whether you pay tax today or in the future, the math works out the same. So the real value of a Roth conversion comes down to one thing: the difference in tax rates. If you convert at a 10% rate today and would have paid 15% in retirement on withdrawal, you come out ahead. If it's the reverse, you lose ground. That's the razor I've preached in just about every Roth conversion video on this channel. But here's where it gets a little bit interesting. In this first smart move, we're going to look at a tax payment method that actually bends this rule a little bit. By changing where you pay the tax bill from, you can quietly tip the math in your favor, even if tax rates themselves don't change. In the first smart move, we're going to be looking at paying taxes from a taxable account rather than paying right out of the Roth conversion. In both of the examples on the screen, we're doing a $100,000 Roth conversion at a 22% tax rate. In situation number 1, we're withholding directly from that conversion and investing $22,000 in our taxable account. In situation 2, we are using that taxable account to pay our Roth conversion taxes, so we'll have that full $100,000 going into the Roth. Growth rate here is 7% per year, capital gains are 15%, and ordinary income tax is 22%. Now, we are paying the exact same tax rate in both scenarios, but now just changing where we pay that tax bill from. I'm going to show you that paying taxes from that taxable account comes out ahead by a reasonable margin, but I want to lay the groundwork for why first. On this channel, you've heard me refer to a taxable account as a leaky bucket. Why is this the case? Well, whether you sell investments in this account or not in a given year, this account will likely generate some tax just from the way that it grows. If you invest in stocks within your taxable account, they will likely throw out dividends each year. This will cause a tax drag on your account. The bigger the dividend yield, the bigger the tax drag. Dividends cause a drag because you receive those dividends, and then in that same year, you have to pay tax on those dividends, whether you reinvest them or not. The tax bill creates a gap that compounds each and every year. The same thing happens with taxable bonds in a taxable account. You earn interest each year from those bonds, but then immediately have to pay taxes on that given interest. This means that you have less invested on your behalf going forward into the future. This is why retirement accounts like traditional IRAs and Roth IRAs are generally better for retirement savings. They shelter taxes during that growth period, allowing compounding to work its magic over the long term. So let's say across all of our accounts, we're investing in a 60-40 portfolio. Stocks grow at 9% and bonds grow at 4% to give us our 7% return. In a Roth IRA, we get that full 7% return, no tax drags, no constraints. However, in our taxable account, dividends and interest will create that tax drag each and every year. As the math shows on the screen, the after-tax return in the taxable account will be 6.42% because of those tax drags. So before I show the result, you might already guess what's going to happen here. By keeping money in our taxable account, we are going to be accepting a lower after-tax return as compared to using this account to maximize our Roth conversion and keep more money in that Roth. Effectively, what we're doing behind the scenes in a pseudo way is basically making a contribution from our taxable account to our Roth by paying the tax from that Roth conversion from our taxable account. This maintains more money in that Roth. And that's exactly what we see. We run the simulation over 20 years and we see that paying taxes out of our taxable account results in over $8,000 of additional value from this one conversion. I also want to note something here. I'm assuming the taxable account in this scenario will receive a step up in basis, and this money will be passed to the next generation tax-free. So that taxable account that grows from $22,000 to $76,000 will have some significant embedded gains that we're basically eliminating with that step up in value. If the retiree in this situation decided to instead use that money during their life, this gap in after-tax value would grow even larger. Now, there's one more step I want to take in this analysis. The fact that we have a gap in after-tax wealth at the end of these 20 years, even though we've equalized out tax rates, means that we could have theoretically afforded to pay a higher tax rate in the scenario where we're paying taxes from the taxable account. This is an asterisk to that equivalency concept we showed earlier. When paying taxes from a taxable account, you can afford to pay a slightly higher rate on that Roth conversion. As we go into the next slide, we'll see that this retiree could have afforded to pay a rate of 24.25%, and they would have still come out ahead, albeit barely. Again, we're assuming this taxable account receives a step up in basis. Now, given this, I think you should still use that initial razor of comparing tax rates now versus tax rates in the future and make decisions based off of that. The main reason here is that there are a lot of variables related to your taxable account that can affect the tax rate that you are able to pay and still come out ahead. If you raise dividends or interest within that account, if you assume that retiree will use their taxable account and not receive a step up in basis, the math changes slightly. So I would still recommend using the tax rate comparison method to determine the value of your Roth conversion, but know that in general, you will come out ahead by using a taxable account for making those Roth conversion tax payments. Now, a quick aside before we move on to the next smart move. Since joining Merit, our team has been able to expand capacity and lower our minimums for viewers of this channel. If you're interested in exploring working with our team and building a better plan, use the link or phone number in the description below and mention that you've been watching our YouTube channel. If you call Merit's main line or fill out a general form, you might be paired with a different Merit advisor who may not share our same planning philosophy or may charge higher fees. Using the link below ensures you connect directly with our team. Strategy number 2, we will touch on timing strategies. What is a timing strategy as it pertains to Roth conversions? Well, timing means the time of the year or an event that triggers when you do your Roth conversion. Most people simply Roth convert at the end of the year, but is this best? What is the value of timing strategies when it pertains to these Roth conversions? This is a very nuanced strategy in an area where, admittedly, I've made some minor errors before. So let's be clear on where timing strategies can be valuable. Let's first explore an example where Roth conversion timing really doesn't matter or add value. These examples are quite hypothetical in nature, just to explain a point. Let's say that we have a couple that determines they will have a benefit from converting just $100,000 from their traditional IRA. They have 5 years in their 60s before Social Security starts to convert without any negative tax hurdles to factor in. Their current taxable income is $50,000, so they have about $70,000 worth of space left in the 12% bracket. Now, remember that initial tax rate equivalency concept we went through off the front end? Because this couple only has a small amount that they need to convert, and they have plenty of time to convert, timing strategies really won't matter here. If they convert at the beginning of the year versus at the end of the year during a market downturn, none of this really matters because they have more than enough space and time to convert at that ideal 12% tax rate. Option 1 and option 2 here put this retiree in the same spot. Let's jump into the next scenario. Same situation, but now this couple identifies that they need to convert $2 million because in this hypothetical, IRAs are that much larger. Well, now we have an issue. There's no way this couple is going to have enough time or space within the 12% bracket to get their conversions done. They will either need to just try to minimize the tax problems they have and convert what they can in the 12% bracket, or they will need to move up into the 22 or maybe even the 24% bracket if it makes sense. In this type of situation where time and conversion space is the constraint, timing strategies can add some value. Here's why. Let's say we look at a Roth conversion at the beginning of the year versus the end of the year. We're going to imagine that the market is going to grow 10% through this year. Say you convert $150,000 at the beginning of the year from a $2 million balance. At the end of the year, you have $165,000 in your Roth IRA and $2.035 million in your traditional IRA. So the growth for the year ends up in your Roth and your traditional IRA is smaller. If you converted at the end of the year, you have $150,000 in your Roth and $2.05 million in your traditional IRA. Timing strategies allow you to get more out of a conversion in a given year if time is constraining that conversion strategy. Let's break out an example using early year conversions versus end of the year conversions. We're looking at a 5-year timeline with the returns that you see on the screen. We're looking at $100,000 conversions off a $1 million IRA balance. Now, obviously, there are no perfect timing strategies. In a year like year 3, when you convert at the beginning of the year and the market goes negative, this strategy works in reverse. Beginning of the year timing would hurt you, but on average, we expect our investments to grow. So as we follow this 5-year timing example, we see the beginning of the year timing ends up with $51,000 more inside of the Roth versus the traditional IRA, basically a half a year's worth of conversions. Now, is this a strategy that is revolutionary? Will this be a strategy that doubles the value of your Roth conversion? Obviously not. But when you are trying to convert and minimize IRA accounts and you don't have enough time to convert all that you want, timing strategy can add some real value. We've had past videos on this channel that show additional timing strategies, like implementing a conversion when investments hit a certain drawdown point. All of these on average have shown to improve Roth conversions as compared to a simple end of the year conversion. However, with all of these strategies, it's worth noting where they can go wrong. Start of the year Roth conversions generally make more sense than end of the year conversions when you have a really good handle on what your tax picture is going to look like throughout the year. However, if you had a bunch of surprise income later in the year, then beginning of the year strategies can risk over converting. Also, if we see a multi-year bear market where during these 5 years the market just fell each and every year, again, beginning of the year conversions would end up working in the opposite direction. But overall, these strategies can add value when used properly. Then in strategy number 3, we'll touch on a smart move that you can implement after performing a bunch of Roth conversions. This concept is called asset location. Here's the basic concept as it pertains to Roth IRAs and traditional IRAs. With a traditional IRA, this is an account that we are trying to keep under control and minimize in certain ways so we don't have big RMDs screwing up our tax situation. With a Roth IRA, this is money that will grow tax-free, and so ideally, we want this to be our best growing account. Well, let's say we're investing in a 60-40 portfolio and we have $600,000 in a traditional IRA and $400,000 in a Roth IRA. Most people intuitively just invest that 60-40 in each account equally. However, if we're thinking about this from a tax focus, we'd be better off taking our Roth IRA and keeping it more aggressive. Maybe an 80-20, maybe even all stocks if your situation permits. This is called asset location. We're locating assets in the right tax buckets. We want to push most of our safety into the traditional IRA, which over long periods of time will cause it to grow more slowly. Let's look at the effect over 20 years given this example. With a 60-40 in each account, we end up with most of our wealth within the traditional IRA, which makes sense because we started with bigger traditional IRA balances. In an optimized asset location scenario, we basically flip this situation on its head. Because we invest more aggressively inside of the Roth, we end up with the Roth IRA being the larger of the two accounts. At the end of the 20 years, we apply a tax rate to the traditional IRA to find our after-tax wealth. We see the asset location scenario comes out anywhere from $100,000 to over $200,000 of extra value. Now, I'm not including any withdrawals as part of this situation. So in the context of large asset values we're looking at, an extra $100,000 on $3 million plus of terminal wealth doesn't seem like much, but let's reframe this. Within this approach, we are investing the exact same way. In terminal wealth terms, the added after-tax value of this approach is worth 2.5% to over 5% in added terminal value. If you break this down to a yearly return, it's approximately 14 basis points to 27 basis points of added return each year. For those unfamiliar with the jargon, 1 basis point is 0.01%. Now, rightfully, a lot of retirees obsess over fees. Why would you invest in a fund at 25 basis points when you could get the same fund at 5 basis points? Well, this is the same effect size in this example. Now, where can this strategy go awry? Well, if you invest your Roth IRA too aggressively and need to take withdrawals from your Roth, then getting too aggressive with asset location can cost you in certain scenarios. So it's important to understand the nuance of all of these strategies and only use them to the point that they're going to benefit your situation. But know that all of these strategies in this video start to add up. A little bit of extra after-tax return here and there compounds, and in many cases can make a pretty big difference. So there you have it. 3 smart ways to get more out of your Roth conversions in 2025 and frankly beyond. At the end of the day, a Roth conversion isn't just about moving money from one account to another. It's about moving it with a plan. As I say on this channel all the time, you don't need more money, you need a better plan. If you found this video helpful, hit the subscribe button so you don't miss future videos. And if you'd like to explore working with our team directly, you'll find a link and phone number in the description below. Thanks so much for watching, and I'll see you in the next video.